Okay. Welcome to Sacred Account Saturday. I'm Jerry Fetta, the owner, founder, and CEO of Wealth Dynamics. It's great to see you today. I'm excited to be going over today's topic. We're going to cover some Sacred Account FAQs. Okay, so really quick, I'm just going to get a couple of things kicked off. First one is going to be just making sure we've got all of our team here ready to go. Good. It looks like we're all good to go here. Perfect. So guys, before we get started, just a couple of things we always cover. So first things first, I want to make sure you have an intention and a reason for being here. If you're on live, you're watching the replay, I want to make sure that you understand, why am I here? What am I trying to get out of today's webinar, today's teaching? Now, we are going to cover FAQs, frequently asked questions on the Sacred Account. So even more so, think about what you want to get out of today, because if you have questions about the Sacred Account now, I do want to answer those. Okay, so we'll be able to mic up and answer those in real time. I will be going through a list too that my team sent on just the most frequently asked questions that they're getting, right? And so I want to go through those, cover them all, and make sure we hit everything. The other thing too is, if you're watching this, I want to introduce a couple of members of my team. Okay, so there's going to be 2 or 3 people you should know about on the webinar today. The first one is going to be Rodrigo Torres. Rodrigo is one of our wealth mentors with Wealth Dynamics. And so both him and then also Brianna Shaw, they're both going to be on the webinar today, reaching out to you in the chat. So if you have questions, they're going to be looking to connect with you and answer those and to help set up a free consultation with you. Our wealth mentors, their focus and purpose is teaching, education, helping you implement what you learn. Right. And so if you're a client, that applies. If you're not yet a client, that applies as well. Those calls are free. We don't charge anything for them. And so if you get a message from Rodrigo or from Brianna, that's what that's about. And that is who they are. Okay. So that's the first thing. The second thing is, if you're not yet a client of ours, I want to make sure that you know that you can and should be getting a free copy of my book today. If you're on the webinar, if you're watching the replay, this is a gift to you. And I'm going to share my screen just so you can see it. Okay, so this is my book, Blueprints of Financial Freedom, right? And right now, if you go to jerryfetta.com/B2F promo, you can get this book completely free, right? We will just cover your shit, or we cover the cost of the book. You'll cover your shipping. We'll send it out to you. And this is going to give you everything you need to know to implement what you're learning on the webinar today. Right. I don't expect that on a 45-minute webinar that you're going to learn everything you need to know about finances to change your life. You're going to learn enough to say, hey, this sounds like it's going to work for me. This sounds like it could help. Let me get more info. Okay. And so this is your opportunity to get more information. If you're like me, I like to get more information before I sign up for things, before I buy things, before I register for things. And so I like to learn. I like to read. Because of that, I also like clients that like to learn and read. I don't want to work with people that aren't willing to read. They're not willing to learn and understand more. Okay, so grab a copy of the book today. Go to jerryfetta.com/B2F promo and you can get that. All right, so that's going to be the main things I want to cover before we jump into it. In addition to that, just a few things we go over every week. So the first thing is we have to remove the idea today before we get started that money and finances are this complicated, hard to understand thing, because that's not the truth. Okay, that's a message that was created by banks, Wall Street, and financial institutions to make us feel like we need them in our lives. The more hard it is, the less we feel we can go at it alone. And that's why we would then go use their products and services, because we feel inadequate and unintelligent, right? So I want to empower you today so that you can learn. And the first step of that is realizing you can know. Okay, money is not hard. Money is not complicated. If you passed 7th grade math, I promise you, you can understand everything you need to know about finances. In fact, we should have learned about it in school and we didn't. I wonder why that is, right? So you can use a calculator, right? If you use your calculator is going to show you most of what you need to know about finances. You can also use a dictionary, right? You'll realize that money is going to be, like financial terms and nomenclature and all this language regarding finances. That's going to be something you can go look up. Right. And so a lot of times what happens is a basic concept with real math that's easy to understand is being used, but it gets replaced with a very complex word. Right. And that very complex word makes us feel like we can't understand. Okay. And instead of looking it up on the dictionary and using our calculator to learn it, then we're like, okay, well, I need to go get, a professional involved. And that's where you get into this trap and this system. right? So on the flip side of this, and this is where most people dwell, but on the other side, and there's fewer people like this, is the know-it-alls. I've seen this before. I've watched this before. I've heard something similar. I already follow so-and-so. Okay, I want to throw that out the window today, right? Repetition is the key to being certain on things. So the more I hear the same message, you'll realize my message on these Sacred Account Saturdays is very similar from week to week because we've got to drive the same point home. Wealth building comes down to like 3 or 4 things. It's not this complicated field. It's doing the same 3 or 4 things over and over and over and over and over. Right. And that's really why every single Saturday it's like, hey, let's drive these points home. Okay. So I have to get rid of the know-it-all. I've heard this. Like, it's kind of like I relate this a lot to going to the gym. You don't train once. It's not something you did. It's something you do every day. Knowledge is not something you did. It's something you do every day and you reinforce or you build. I'm either building with new knowledge or I'm reinforcing existing knowledge to become more certain. Right. And there's not that much new knowledge you need. If you're a client of mine, especially, like, you've got the basics down, good. Let's reinforce the existing knowledge and let's work on implementation. Okay. The faster I move, that's going to be tied to how many times did I do repetition on the subject matter. Right. Anyone that's done anything at a high level, the more you do it, the more frequent you are, right? The faster you get, the more results you get. Right. So those are the main things I want to cover. So again, as we're going through this, you're going to be getting a message either from Rodrigo on my team or Brianna Shaw on my team. They are both endorsed wealth mentors. Just to bring this back to them, they're both endorsed wealth mentors of mine. And so what that means is that they have my personal endorsement to work with you one-on-one and to mentor you through your wealth building, through your greater financial freedom increase, your journey to financial independence. We call it the blueprint to financial freedom. Okay, they're licensed, they're certified, they've been trained by me to mentor you on that. Right. And so they're endorsed by me, they're reaching out, they're going to want to set up an appointment. So if you're new, the purpose of that appointment is for you to start getting help from our team. Okay, we would love for you to be a client. We want to add value to you. And that's what's going to happen on that call. If you're existing, their goal is to service you, find out what your problems are, how they can help create solutions and get you moving even quicker. Right. And that way everyone is able to achieve greater financial freedom. And one of my main goals and purposes in life, guys, is to create a ripple effect. I want a ripple effect of good people, like, I mean, truly good people that have the money and power in this world. Right. When I'm, 100 something years old and I finally die, that's what I want my legacy to be, is that I dropped the stone in the water that created that. Okay. And if you're one of those people and you're like, hey, I want to be financially independent because I want to take care of my family, and I want to help my community, and I want to improve conditions around me, and I want to donate to my church, and I want to make sure that, people have more freedom and are more educated and more opportunities are available, and we get rid of injustices, and we help the good people and we keep the bad people away from them. Like, if you're that kind of person, I want to help you get there. Okay, that's what this is about for me. This is not about me teaching my knowledge because I'm so smart. I spent time learning this because that's what I wanted to do. Guys, I grew up poor. I grew up with watching, my mom and dad have their marriage fall apart over finances. I went through my home being taken away when I was 9 years old, car getting repoed, mom and dad got divorced, all in that same summer. And we were homeless to add on top of that. That same, all happened in 1 year, guys. And it was all financial related. Right. And so for me, that was a point of being a victim, being the effect in life. Anytime, here's something I want you to write down. Anytime something happens to you in your life, that in the financial realm, and this applies to anything, but let's focus on the financial realm. Anytime something happens to you in your life financially that you didn't like, it was a bad experience, what that means is you weren't in control in that moment. And you weren't in control in that moment because you didn't hold the responsibility for whatever that thing was. And the reason you didn't hold the responsibility for whatever that thing was is because you lacked the knowledge to be able to do so. See, those that have great knowledge and they have that knowledge and use it, then have responsibility. Okay, knowledge isn't power. Applied knowledge is power. I can learn something and it's going to make me, this no different than an almanac book of neat little facts. Right? Or an AI. Who's checked out this Chat GPT thing? I've been using this a lot lately, the Chat GPT. This is as smart as most human beings right now. So what's the difference between you and something I can type into Google? Right? Think about that. Me just knowing stuff doesn't help. It makes me now the same as a free app I can get on Google. Okay, there's no value there for me or for anyone else, for me just to know information. If I'm not actively doing something about it and with it to change the world around me, That's the difference. Is this app cannot get out of my phone and go help someone. You can. This app cannot donate money. You can. This app cannot, help a family member out. You can. We're going into a day and age where like it's going to be like if you're not above and beyond what an app can do or an AI can do, like what are you doing? Okay, having money, having resources, and having good intention, those are probably the most valuable things in the world. If you combine all that, somebody who has money and they have resources and they have good intentions, a lot of problems can get solved. A lot of improvement can be made for humanity. So that's my goal. That's why I'm teaching this today, okay? So that's also why we're giving away a free consultation. That's why we pay Ron and Brianna to do those, is because we want them to help. We want to help create that ripple effect. That's why we give the book away. Okay, I wrote a book. I've written 3 books now. We're working on 3 more this year. I looked at the statistic, less than 0.002% of the population has published a book. Right, so it's not this thing everyone's doing, and it's not easy. And so when someone writes a book and they're like, hey, I'm not trying to make money on it, I'm trying to just give it away and get it out there, that's because they want to help. Right, you'll see these, and then you'll have people where they want to charge a lot for a book because they're trying to make money on it. For me, I'm not trying to make money on a book. I'm trying to spread information that will help. Information that was hard fought for. You guys have to understand that I became a licensed financial advisor first. Okay, that's after my backstory of watching my family's life fall apart because of bad financial education, having my parents be divorced, losing the house, losing the car, being homeless. Right, I was homeless, I think 3 different times. One was the same year at my mom's house and my dad's house. Then later on in life, I was homeless when I first got married. Right, like and I remember when I was 17, 18 years old, realizing that the US dollar wasn't backed by anything and saying, I'm not going to trade time for money. I'm not going to play the economics game, and I'm going to opt out of it. And I, within a year, was homeless. Okay, I'm not able to help anyone doing that. This is a selfish decision. Right, like we can all look, we're all in the same situation. We all live on the same planet. We all see the same problems around us. We all see the same situation, right? There's 3 options we have for all of it, economically related. The first one is poverty. Okay, I can quit. That's what I did. I was like, I quit. I'm not doing this. I'm going into apathy. I'm not going to participate. Right? Now, I can't help anyone doing that. And sure, I'm not as involved with money, and it's not this thing that I'm concerned about, and my life doesn't revolve around all this stuff. That's great. Cool. Okay, but being homeless was what that ended up with. Right? How low can I go? That's the problem with this, is I'm going down as low as I can take it with poverty. Right? I'm reducing my influence. I'm reducing my ability to affect change. Right? The middle option is what most people do. That's called denial. Denial is the middle class. Okay, denial is everything's peachy. I've got my dream home. We pay our mortgage every month. We've got our 2 little German vehicles. We go out to eat every weekend, and we're comfortable and life's good. That's called denial. Right? Satisfaction, content. I'm trying to keep that there because I don't want to have to confront what's around me. I don't want to have to look at the problems in the world because I don't want to have to do anything to fix it. You see, as soon as I see it, now I'm either part of the problem or I'm part of the solution. If I'm not looking at it, then I can act like it doesn't happen. Right? The other one is wealth. Wealth is having abundance and prosperity in all dynamics of life, having, financial independence, having passive income that exceeds my savings, expenses, and taxes. Right? And having wealth, like having financial wealth, being able to treat money like oxygen, that's wealth. Abundance. Abundance means that I can live life by design the way that I want to. I can contribute the way that I want to. Right? And that's what this is about. And then we start looking at, well, how do we get there? And that's how we come to things like the Sacred Account Saturday. If it really matters, I start thinking about how am I going to get there? And then I start thinking about what are the tools? What do I need to have? Right? And we start looking at, okay, well, if I'm really going to do this, I need to do it the right way. So how do I do it? Who do I use? What tools do I use? Right? And that's where people fall apart because there's so many out there. There's everything, there's nothing. You got to use this, you got to use that. So I'm going to give you one simple trick to be able to filter through all that before we get started with our FAQs. Okay. Find old, dead, successful people and use what they used. Look at the most successful people, the ones that are old and they're dead. They're not around anymore. Right? And figure out what did they do, and let's just copy them. Copy them to the best of your ability. And if you do that, you'll be successful. And that's all my book is. This book, Blueprints of Financial Freedom. This is not Jerry Fetta. even though I authored it, this was, guys, this was the last, 10, 11, 12 years of research, studying the Rockefellers, studying Andrew Carnegie, studying JP Morgan, studying Ray Kroc, studying that Teddy Roosevelt, studying the banks, right? Studying these top 1%ers, all dead successful people, and looking at what did they actually do. And then by trial and error, figuring out what works and what doesn't. And then when I finally found it, this was the sequence. These were the tools. This is how they did it, publishing it so that it could help others, because you don't need to do a decade's worth of research to find the same things. Okay, now this is very different than what's out there. When you go out there and you start researching how do I become financially free, what you're going to be offered are what I would consider gimmicks. And this doesn't mean bad. A gimmick just means it's a doodad, it's a thing. You're going to be offered a bunch of silver bullets. The life insurance even being one of them. You're going to hear things like, oh, if you get the infinite banking concept or the life insurance, this is the missing piece of the puzzle. There isn't a missing piece of the puzzle. You're trying to build financial freedom. It's like building a house. You need all the materials. So someone can't be like, oh, all you need is windows. This is the key, is to have windows. No, you need a door, you need a foundation, you need trusses, you need a roof, you need the walls, you need everything. So it's not about the magic missing thing. It's about what are all the things? What's the timing for each of them? What's the sequence? Do I have a team who can actually build it for me? Because I'm not going to go build it myself. Right? If we're relating this to a home, if I'm going to go get a house, I'm not going to be like, yep, give me the hammer and the nail. I'm going to go do it myself. Why? Because I'm not a professional and I've never done it before. I want a team helping me. Same thing with wealth. If I've not already built wealth, I'm not going to go at it by myself and be like, oh yeah, give me the tools, I'll go figure it out. That's how you end up with a giant mess. Don't practice on yourself. Same reason you wouldn't go to the doctor for your own surgery. You wouldn't be like, instead of going to the doctor, I'm going to go in my bathroom with a scalpel and a steak knife and I'm going to give myself a heart transplant. You would never do that. But with finances, we tend to do that. We tend to Google it and be like, I can figure it out. I saw a YouTube video on this stuff, right? And then we wonder why it turned out so bad. Okay, so you need to have support. You need to have a team. You need to have people that are going to be there, that are going to walk you through, that are going to educate you and make sure you understand how this all works. And that's the purpose of today. Okay, so I'm going to go through some frequently asked questions on the Sacred account. It's good to see everyone on here, by the way. If you guys have questions on the account, I want you to drop them in the chat and we'll actually go through and answer those today. Okay, so the first question is, what is the Sacred account? And I want to cover this just because not everyone has this answer. A lot of you guys might. And so I'm just going to sketch this out for us all really quick. Let me grab my trusty pen here if I can find it. Here we go. Good. So what is the Sacred account is the question, right? So the Sacred account is a form of high early cash value, dividend paying whole life insurance. High early cash value, dividend paying whole life insurance. Okay, now this is a very long name because it's a very specific tool, right? We're not saying just life insurance. We're not just saying whole life insurance. We're not even saying cash value life insurance. We're saying high early cash value. It means life insurance, it's whole life insurance. It's going to have a cash value that I can save into it. And that cash value is very high. There's a lot of money that goes into it up front. And what this is going to accomplish is two different sides of the house. Okay, first one is going to be protections. Okay, and the second one is going to be growth, right? And so on the side of protection, okay, there's a couple of things that I have. The first one is I have a guarantee against loss when I put money into this account. Okay, I also have guaranteed growth. That's going to give me some protection to know I have money growing for sure. I'm not going to lose. I'm protected from taxes. I'm protected from creditors, protected from lawsuits, protection of privacy, the unilateral contract between me and the insurance company, right? So there's a lot of protections here. I've got a death benefit that protects me. I'm an owner in the company that protects me as well. My funds are fully allocated. That's a protection as well. They're not loaning it out to a bunch of people where the money's not actually there. My company, the company itself is insured against insolvency. That's protection as well, right? These are all protections I have in my account, right? Now, I don't get this with most places that I would save. Okay, and this is one of the reasons I would use the sacred account is I want all of this. I want my money to be protected against loss. I want to know for sure I'm going to get growth. Okay, I don't want to pay taxes. I don't want creditors to be able to access my funds. I don't want to have a lawsuit come after my money. I want privacy. Okay, I would like a death benefit where my family gets more money tax-free than I actually had, just in case I die before I build wealth for them. They're still going to be able to make it. Right? I want to be the owner in the company so that way they don't take advantage of me, and whatever they do to me happens to them also. I want my money fully allocated where it's actually there. I want to have the company insured against insolvency just in case. Right? These are all protections with the sacred account. So that's one of the things it does. Okay. The other side of this is growth. Right? So on the growth side, I'm going to earn a 3 to 5% compound annual growth rate for life. Okay. It's going to be tax-free growth. Okay, I'm going to have guaranteed minimums on this. I can borrow against my account, and I can do what's called arbitrage. What does that mean? I want to just sketch this out really quick. Okay, so let's say that I have, $1,000, and I put this into my life insurance, into my sacred account. Boom, I drop it in there. Okay, so this $1,000 is going to grow from now until either I turn 121 years old or I die. Whichever one happens first. But until then, it's going to grow at about 3 to 5% per year on average, right? So that's called a compounding annual growth rate, CAGR. Compounding means it's compounding interest. Annual, on an annual basis, it's compounding. It's a rate of growth rate. Great. So I'm going to earn 3 to 5% compounding annual growth rate on my $1,000. Now, while I'm having this money in there growing, I can borrow 70 to 90% of it at an interest cost of about 1 to 3% and still earn the 3 to 5% on my 1,000. Okay, so the average here on my growth is about 4. That's the difference between 3 and 5. If I'm paying interest to borrow, the difference between the 1 to 3% is 2%. So I'm paying about a 2% rate to borrow. So I'm earning 4, paying 2, which means when I borrow this 70 to 90%, I'm making a positive 2% spread to borrow against my money and go use it for smart things, right? This is like a glorified savings account. I put money in here. It's going to pay me a higher rate than the bank. It's going to give me more protection. It's going to give me the same access. Plus, it gives me the ability to earn this 2% spread to borrow against my own money, to then take these funds and invest this for passive income or to pay off debt or to make large purchases. Okay. But the big key here is, let's say we were investing this for passive income and we could be earning 12 to 14% a year. Let's say that that's what we could make doing, real estate investing or whatever. Okay. Do you want to make 12 to 14%, or do you want to make 12 to 14% plus another 2? I would take the other 2, right? So how do we do that? By using the sacred account. We don't use the sacred account. We don't have this other 2. We just put the 1,000 directly here and that's it. Versus we put the 1,000 here, it's growing at 3 to 5. We borrow against it. We do the same real estate we were already going to do, and then we make a 2% extra return on top of that. 2% per year over the next 30 years, that's going to give you about another 30 to 40% overall rate of growth on your investments. That's why we do the sacred account. That's what this is, guys. Now, it's called life insurance, right? But if we look at what it does, that's what it does. This is not what most life insurance does. See, I almost didn't believe this when I saw it, because I was like, there's no way that this is actually possible. Till I actually started studying it and I saw that, shoot, Ray Kroc had one, Walt Disney had one, Teddy Roosevelt had one, Pampered Chef had one, Foster Farms used it, Stanford University had one, Joe Biden has 6 of them, right? We look at the wealthy, the Rockefellers, if you're a Rockefeller descendant, to take money out of the family trust, you must have one of these. If you do not have one, you cannot have money. That's how important it is for them and their heirs to have their life insurance policy, to have their sacred account, right? Think about that, to require it. Like if you don't have one, you're cut off. You don't get it. You don't get anything from us, right? So I start looking at that. And then I also realized 3,000 of the largest banks, more than 3,000 of the largest banks in the United States of America, keep about 20% of their best, like their reserves, in life insurance, this kind of life insurance. Collectively over $200 billion. They're the largest buyer and owner of life insurance in the country. Right? That's what the sacred account is. So that's the first FAQ, is what is it, right? Now, if you've been watching this and that just made sense to you right there, and you're like, wow, I didn't know that it does that, or that was like a new thing, and you're like, this is something I'm interested in, I want you to reach out to Brianna or Rodrigo and say, hey, I'd like to set up an appointment and get my sacred account set up. Okay, the appointment's free. They'll answer your questions and they'll get you started. Okay, the next question here is how much or when and how much exactly can I borrow from my policy? So this is regarding policy loans. We talked about the borrowing thing. Okay, and again, why would we borrow? We would borrow because of two reasons. We have an account that's growing. We don't want to sell it and distribute the money. Then we get rid of the growth. So by borrowing, the money's still there and it's still growing. Okay. I never want to get rid of a productive asset. The second thing is if I have a productive asset that has a gain and it's grown and I sell it, I'm also going to pay taxes. So by borrowing, I don't pay taxes because the IRS cannot tax a loan. So we're solving the top two problems of a wealthy individual here. You can see why they put so much money into it. A wealthy person never wants to get rid of a productive asset. Go study Warren Buffett, guys. He'll tell you buy great companies and never sell them. Go look at Grant Cardone with real estate. He'll say buy the best properties and keep them forever. Right? So I want to do that. With my Sacred account, I can do that. I never want to get rid of the asset. Okay, and then if you study the wealthy, none of them like paying taxes. They invent things in the tax code through lobbyists to create laws so they don't have to pay their taxes legally. So legally, if you borrow against an asset, no, it's not taxable. Right now, what's even better is if long-term, the cost of that interest is covered by the growth of the asset itself. And then it's like, wow, I just took a loan and got paid to avoid my taxes on a legal basis as well. Right? So how much can I borrow? Year one, you're going to be able to borrow 70 to 90% of what you put into your policy. Okay, this is going to increase every year. In year two, this might be, 80 to 95%. Year three, it'll increase. Year four, it'll increase. And you're going to hit usually between year 5 to year 7, you're going to hit what's called your break even. Your break even means that the amount of money you can borrow is actually more than you put in. Right? Like you've got the ability to borrow more money than you actually even put into your policy. That's called a break even, right? So you might be able to borrow, let's say 110% of what you put into it. Why? Because you're a partner in the insurance company. As they're profitable, they're paying you dividends every year, tax-free. That's going to build up your account and you're going to be able to borrow against not only what you put in, but also the growth. Right? So these first years, and this is going to be different on every illustration. When you look at a life insurance illustration, you're going to see year by year what your net cash value is, what you can borrow against. Right? So that's going to be the answer to that question of how much can I borrow? Okay, the next question I have here is when I take a loan, how fast will funds arrive? Okay, so depending on the company here, we work with about 5 or 6 different insurance companies for these types of policies. On the longest request timeline, the first month is usually the longest. It might take an entire month before you actually see your loan come in. Okay, so that could be 2 to 4 weeks depending on the company. And the reason for that is you just set up the account. They need to make sure that you're actually like requesting the loan. You've got your paperwork in order. You've got your ACH stuff in order, and they can send you that first loan. And it takes a little bit more time. Okay, after that first one's done, then loans are very quick. My experience has been with my policy, when I take a loan against it, it's a couple of days, right? It's the amount of time for me to fill out the forms, e-sign it, or click online and do the deal there. And then for the insurance company to wire the money to my bank account. Okay. Now a policy loan might take longer if you're having them mail a check, right? Then it's snail mail and then you're dealing with postal and all that kind of stuff, right? Jocelyn asks on the borrowing thing, what determines the percentage you can borrow? So that's really going to be the amount of cash value you have versus the insurance costs, right? So this is a life insurance policy. The goal is we want to minimize the insurance costs, maximize the cash value. And so that's going to determine how much you can borrow. So if you have higher insurance costs, you'll have less money to borrow up front. Now, that's not necessarily a bad thing, Jocelyn. There's different designs for these policies. So someone that's like their goal is, hey, I want to borrow the most money possible in year one. We're going to design it for that. Now, somebody else that says, hey, I want the highest internal rate of return. We might actually have a little bit less ability to borrow the first few years because we're investing more into the policy growing than having more cash up front. But longer term, that policy is probably going to perform better, right? So there's a lot of, I want to stress this, Jocelyn, there's a lot of customization that goes into this. It's not just, you go in and you say, hey, I want a policy. We're like, cool, here's the policy. We look at, okay, well, what are you going to use it for? What are your goals? Tell us about you, your health, your age, all of this different stuff. And then we look at which insurance carrier is going to do the best job. and then specifically with that carrier, which design is right for you and your goals, right? So that's why we give that range 70 to 90. I've seen policies come out with maybe 50 or 60 borrowing in the first year because the person was like, yeah, I'm not looking to borrow the first year. I want growth. So we're like, cool. So let's dial it down a little bit that first year to accelerate the long-term growth of that policy. And so that's, again, a thing you want to look at is like, what's your intention with it? Okay, so one of the FAQs we had is why would it be if I requested a loan, it's still not arrived? So this is a question we get. Again, these are FAQs. So sometimes frequently people will ask, hey, why hasn't my loan arrived yet? Right. And so this can be a number of things. It could be a paperwork issue, right? It could be something where, I didn't, sign up for the policy correctly and there was an admin mistake. It could just be that it's my first loan and it's going to take 2 to 4 weeks. It could be that they're mailing a check and I thought they were going to do a wire and there was some miscommunication there. And so really with this one, if I have a sacred account, and guys, this is where you need to work with an agency. Like, I'm just going to say, work with our team, We're experts at this. We've been doing this for a long time. We've got the very best in the industry as far as putting your account together. Work with someone that is actually going to be able to service you on the back end. Too many people set up a life insurance policy because they hear stuff like this and like, yeah, I'm going to go set up my sacred account and it's going to be awesome. And it's like, I'm going to go buy a Formula One car and teach myself how to drive it. It's not going to be a fun experience for you. You need someone that's actually, they can coach you and teach you. So when you're a client with us, not only do we give you white glove service, we do your entire underwriting, onboarding, your application, we shop the carriers, we design the policy, we get it approved. But after your policy is in force, we have a team called the mapping team. The full-time job of our mapping team is to service you. Okay, to answer your questions. When a policy loan's taken a while, you can reach out to us and we can say, great, here's what's happening. You don't need to worry about it. We take care of it for you. We're here to help you build wealth. So we want to clear the field so you can just run and do your thing, right? So our mapping team does that. Most companies don't offer that. You get one person who's the agent. Their job is to go sell more policies. They're not really able to service you, right? You need a team. And so our mapping team, they're going to help you with strategies, questions, those types of things. This one says, I want to put cash urgently into my policy, but apparently I can't because of my MEC line. So your MEC line is your annual contribution limit. This is a good question. Each policy is going to be different on this number. So back in the 1980s, like there was no limit on how much people could put into a life insurance policy. So wealthy families, think about it, guys. You like, once you put money into it, it never goes to the IRS. It never goes to the banks. It never goes to Wall Street. You'll never pay taxes again. Creditors can't touch it. Lawsuits can't touch it. Privacy is completely protected. If you were wealthy, how much money would you be putting into one of these? For me, all of it, right? Like you're telling me I put money in and I never pay taxes again. My money is bulletproof. I'm going to put all of my money into this. And that's what people were doing. Wealthy families were putting a lot of money into these policies because there was no limitation. They just could. Okay, so the IRS came around, Congress came around, they said, okay, cool. If we keep having this happen, the economy is going to fail. Imagine a population where nobody paid any income tax. Nobody went to the bank because they could bank on themselves. Wall Street didn't get a dime from people. Okay, that's not good for the economy, right? Even though it's good for the individual, it's not good for the large corporations. The individual, they're winning. They're loving it. They're like, I don't ever have to pay interest to a bank. I don't ever have to pay income tax again. Like, these are great things. I'm never going to lose money. Like, where do I put more? How do I sign up? And this is why I don't understand when people are like, like, oh, I'm skeptical. And it's like, right now, do you know where you're putting your money? Do you realize what happens when your money goes into a checking account? Do you realize what happens when you fund your 401k? Do you realize what's happening when you overpay on your taxes and get a refund at the end of the year from the IRS? And people are skeptical of this. The sacred account, it's been around longer than your bank. It's been around longer than your mortgage. It's been around longer than your Wall Street company. It's been around longer than the IRS. And you're skeptical of this one, right? It makes zero sense, okay? That's just my little rant, but I see that and I'm like, why? And how come you didn't put the same level of skepticism into giving all your money to Wells Fargo, who just got hit with a multi-billion-dollar fine for taking advantage of their customers last month? Right? I don't even remember what the FAQ was. I get fired up on that. Okay, so my MEC limit. So the MEC limit, that's the contribution limit. So in the 80s, the Congress came out, they said, hey, there's a limitation. You can't just put all your money in life insurance. You need to pay your taxes. Like this doesn't work. So they came out with legislation and they said, hey, this is the limit. It's based on the projected growth of the policy, the cash value, and the death benefit, right? So they're all going to be different based on how much money you're putting in, your age, your cash value, your death benefit. You will have your own custom number on what the contribution limit is for your policy. Okay. And so the MEC limit, you can't put more money in past whatever the number might be, right? So a lot of times it's about 3 to 5 times what your scheduled contributions are. So if I'm putting in 10K a year, my MEC limit's probably somewhere around 30,000, right? Just ballpark. Don't quote me on that because it's going to be whatever it is for your account. So when the MEC limit happens, you can't put more money into it. That's it. You're done for the year. Now, what's the solution to this? Now, we've changed our philosophy on this in the last year or so. We used to design the highest possible MEC limit on your first account. Okay, we'd say, let's do the highest possible MEC limit on your first account. So we'd say, good, we're going to jack it all up with term insurance writers and all this stuff to give you the highest MEC limit possible. And then you could put a bunch of money into your first policy. Now, the problem is you max out that first policy, which your client, if you're watching this, many of you have done, you're killing it. That's, by the way, that's awesome. Like, congratulations, I acknowledge you. I want to say good job. If you've maxed out your policy, that means you funded fully your very first bank. Okay. Now, what do you do to scale? You open up another location. Think about it. You're becoming your own bank. Why would you have just one bank location? Why not have 2? Right? So you open another policy. Now, if we set the first policy up to maximize your total insurance availability in MEC, it limits your ability to open a second one because you used it all up on the first one. So instead, what we do is we say, let's set up just what you need on the first one. Okay. What do you think you're going to put into it? And let's try and target it for that. Then we can open up a second one and a third one and a fourth one. And we started doing this design. We started working with the Money Multiplier Agency. And by the way, I'm doing a webinar Wednesday night, 6:30 p.m. Eastern time with Chris Noggle. He's my partner in this, with doing the infinite banking and the sacred account. We work with his group very closely on this. And so he said, hey, like if we tweak this a bit, here's the result. Okay. And so there's a guy that I know that does it this way. You know, he's an agent. He's been doing this for, 20, 30 years now. He has 40 something policies, 40 something different policies he's got. Okay. As a bank, he has 40 something locations. Who's going to win? One person with one really good location or a guy that has 40 decent locations? Scale always wins. You want more, right? Scale always wins. And this gives you more growth in the long run. So that's what you would do is if you maxed out your MEC limit, let's open your second policy. Let's do it quickly. Let's get it done. Like most of our clients, we should be opening on a second policy within the first year. Okay, next question. I'm not able to pay my monthly premium. I do not have enough income. How do I reduce it? Maybe they lost their job, the income went down. Okay, so this is really where you want to design it for worst case scenario on your first one. You can't lower it. That's the thing, is it's a forced automated savings plan. So you can put in more money. You can't reduce it down. So if I set up my account and I'm like, hey, I want to put in $1,000 a month, I'm not going to be able to go lower than that. So I want to give you some guidelines here on funding your account. So when you're funding your account, if you are under age 60, here's the minimum you have to put into your policy. Either 10 times your age per month or 10% of whatever your lump sum is, whichever is greater. That's the least you can put in. Now you do this, you commit to this when you sign up. So I'm 30. And if I'm not putting in a lump sum, I would need to do 10 times my age per month. 30 times 10, that's 300. I need to do a minimum of $300 a month to even just open a policy, right? So that's the first one. Now, if I'm doing a lump sum, it needs to be at least 10% of that lump sum. And it's going to be whatever the greater number is between these two. So let's say that I'm doing a $100,000 lump sum. Well, 10% of that is 10 grand. Okay, 10 grand a year. That's more than $300 a month. $3,600 a year is $300 a month. So that means my minimum on that one needs to be $10,000 a year, not $300 a month or $3,600 per year. That's just to sign up and get in the door. Now, if I applied for, let's say $10,000 a year, and year one it's going in, it's fine. Year two, I'm like, oh, I just had my income drop. I really can't reduce it. Okay, my option in that scenario is I can take a policy loan to pay my premium. Okay, so I can actually borrow from my cash value to pay my premium. And then once my income comes back up, I would basically say, okay, good. Now I'm going to pay myself back. Now, what I'm going to say next here might sting a little bit. If your income went down, you're not doing finances right. Okay, your income should go up. The ideal scene is not decreasing income. The ideal scene is increasing income. So if my income's decreasing, I'm like, what the heck? What am I doing wrong? Not, can I go reduce my savings? That's even worse. Realize the 3 stats you should track the most in order to become financially independent is your income, your savings rate, and your investments, right? So if my income drops, why would the solution be to then go lower the next statistic to build wealth? No, like that's a very bad idea. That's like saying, okay, I just got diagnosed with heart disease, therefore I'm going to stop going to the gym now. No, do more gym, right? Like increase your activity level. So my income drops. Instead of saying, how can I lower my savings rate, which is really, if you ask me, the coward's way out, I would be looking at how do I increase my income? But that takes a certain level of responsibility that not everyone has, where they're going to go into, oh, I don't know, and what if, and I'd have to watch less Netflix if I did that. Then watch less Netflix. Like go get a part-time job. If it really matters to you, you'll do it. We're not talking about like, having some minimal goal here. We're talking about your financial independence. We're talking about your ability to financially impact and improve mankind. And you're not willing to go earn more income, and your solution is I'm going to save less money. Okay, and me and Brianna had a call with someone this week. We did a free call with them. The guy's like, yeah, I'm ready to go, and completely ghosts us. Okay, what does that tell me about that individual? It means that he's not serious about his goals. Right? We're trying to help. When someone's trying to help and it's a good goal and you don't do it, that means you're not serious about your goal. He's not serious about being financially free. To a degree, he actually likes, agrees with, and would love to continue to be in financial slavery to the degree that he's not willing to change it. When somebody is in a non-optimal situation and they're not willing to change it, it means that they like that thing, they agree with it, and they want to keep doing it to the degree that they're not willing to change. Right? Think about this. Like, otherwise, why would they not change? That's it. They like it, they agree with it, and they want to keep communicating with it. So they keep doing it. They don't get rid of the thing. Okay? So that being said, we don't bump it down. Now, I want to answer the rest of this. If you're over age 60, so 60 or over, 15 times age per month, or 10% of lump sum, whichever is greater, right? At a maximum, on a scheduled basis, you'll be able to schedule at a maximum about 25% of income into your sacred account, not including lump sums. Lump sums are different. You can pretty much put in whatever the lump sum is, as long as you can meet this matrix of 10% of that lump sum, and it's not more than 25% of your income on that 10%. That's how you figure out like how do I do my contributions, right? So an ideal scene would be I sign up for my first account, I fund it, I do the deal with it, I'm putting money away, my income goes up. Okay, we teach you increase your income, my income goes up. And then as my income goes up, I can now afford a higher percentage of my income to go into my sacred account. So I open up another one. And I continue doing that, and my income continues to go up and up and up and up and up. Right? That's an ideal scene. And that's what we help you with. Like, that's where we're different. One of the things that I decided many years ago is I didn't want to be a wealth manager. Okay, I didn't want to be the guy you come to and you're like, here are my assets, go put them into investments and I hope they do well. No, I want to be a wealth creator. And you can't create wealth without creating more income. You can't create wealth without saving more money. Okay, I'm actually not even focused as heavily on the investing side. Like, I want to find one that works and be done and just use it. Right? Like same thing. Like, if I'm Chick-fil-A, why would I be focused on opening other brands of restaurants if Chick-fil-A works and I just need more locations of that? Okay, so what's the most scalable investment in the world? Like mortgages, seller finance, or private lending. Those are the most scalable investments in the world. You look at the largest institutions, the banks, they all do mortgages. They're not doing rental properties. They're not doing, angel investing or crypto or partnership, and they're doing mortgages. So if I just copy them, then all I need to do is increase my income, increase my savings rate, put it in my sacred account, stick it into a private lending or a seller finance deal. Okay, I like seller finance. Seller finance to me gives me a lot more control and downside protection. Right? I don't really want to be in a fund. I want to actually have the asset. Right? And so that's an important thing for me. So I want that there. I want to know that it works. I don't have to think about it, worry about it, mess with it. It can be a stable piece in my triangle of wealth. then I focus all my attention on increase my income, increase my savings rate, fund my sacred accounts. Take a loan, put it into seller finance, repeat point number one. That's it, guys. If you just did that over and over and over as fast as you could, that's the game. Okay, are there other things that could we reduce your taxes? Yep, cool. Let's do that over here real quick. Boom. Now let's go back into our main points. Increase the income, increase the savings rate, invest in seller finance, real estate, repeat, go back to the top. Okay, so all of that is my answer to the MEC limit. Okay, next question here. We're going to wrap up in a few more questions. Why is my death benefit so low? This is a great question. So, okay, I'm gonna sketch this out, and I want to make sure I keep this simple because this is an easy one to lose people on. So when I put money into a policy, we're looking at cash value and we're looking at death benefit. Okay, so the more death benefit I have, the higher my cost will be, the less cash value I will have. Right now, that doesn't mean the death benefit's bad. Some people go completely, polar opposite. Oh, I never want a death benefit. Then okay, that's the same thing as a bank. Having zero death benefit, you might as well stick it in a bank. So a death benefit, what is this? This is actually a unit of ownership in the insurance company or a share. So when I have whole life death benefit, or you'll hear it called base premium death benefit, that's actually per $1,000 of death benefit. That's one unit of death benefit. Each of those units is a share in the insurance company. That's where my profits and dividends come from. So here's the catch-22. The less death benefit I have, the more high cash value I'll have, but also the lower my dividends. The more death benefit I have, the less cash value I will get, but also the higher my dividends. So this is a question now of short-term versus long-term gratification. Do I want more cash today with less growth tomorrow, or do I want less cash today with more growth tomorrow? No right or wrong answer. If I'm in debt right now, or I need to borrow it for reserves, or I'm trying to do a real estate deal with it next month, then I'm going to probably say, hey, I need as much cash as possible, even if the growth is a little bit lower, because I just need the cash right now. Okay, I'm trying to get out of debt. Right now, if I'm like, hey, I'm past this, realize handling debt is handling the past. That's not strategic. That's actually a form of coping. Okay, do we need to do it? Definitely. Let's get rid of the debt. But once I'm in present time with my finances and I'm not paying back expenses from years ago that I borrowed money from others to cover, or I'm finally paying up on my own stuff, right now I can look forward and be strategic. What's my plan? And when I'm strategic, I would say I would probably want to have the higher rate of growth. So what do? We have something called the Sacred Account Lite. The Sacred Account Lite is a reduced version focused on two things: high cash value, so that people can either pay off debt or build immediate reserves. That's the purpose of the Sacred Account Lite. Now we have one called the Sacred Account Premium or Premier, whichever you'd like to call it. And the Sacred Account Premium, this one is for someone that has no debt. They've got their 6 months of reserves. Now we're focused on long-range growth, high rate of return. We're really capitalizing this as a strategy, right? And so on my cash value, if I'm doing really high cash value, the point is I want to have a smaller death benefit. To answer that question, why is my death benefit so low? Probably because we don't want it to be super high right now. If you're doing your very first policy and it's a light policy and we're trying to maximize the cash value, then yeah, we're trying to minimize the death benefit. Okay, now if we're down the line and we're past that point and we're like, good, I want to be strategic, I want to focus on growth and long-term wealth building, then we might sacrifice some of the cash value, increase the death benefit a bit in order to optimize that. Okay, I think we've got time for a few more questions. I did see a couple more come in. We have a question: if you don't reach your MEC limit, does it roll over to the next year? With most companies, the answer to that's going to be yes. It's like, those old cell phone minutes, right? You don't use your minutes up, it rolls forward to the next month. With the MEC line, with most carriers, that's how that's going to work, is you've got an annual limit. And if you don't use it, it rolls forward to the next year. And then it's the next year, you've got the brand new MEC limit plus whatever you didn't use from last year. Good. We had, so someone asked, will this be recorded? This does get recorded. So this is going to go on my YouTube channel. Okay. This will go also on my podcast, which you can listen to on Spotify, iTunes, Audible, Amazon, anywhere you listen to podcasts, really. And then we will send this out on our email list. So if you're a subscriber on our email list, you'll get the replay for this as well. And then I just want to remind you guys, reach out in the comments. Okay, check out in your chat. I want you to reach out to Brianna. I want you to reach out to Rodrigo. And if they sent you a message, I want you to connect with them. Okay, and again, if you've not grabbed a copy of the book here, I want to invite you to do that. So if you go to, again, it's going to be jerryfetta.com/B2F promo. You can get a free copy of the book. We cover the book. I pay for the book out of pocket. You cover the shipping. We'll send it out to you. Okay, that's the deal there. That's going to give you some more information to move forward with from today. And if you're ready to set up a policy or a second policy for that matter, I want you to reach out to my team. Reach out to Brianna, reach out to Rodrigo and say, hey, I'm ready to get started. Okay, I understand the strategy. This makes sense. Okay, and who does this make the most sense for before I wrap up? It makes the most sense for someone who's already doing the right things. They're just doing them with the wrong tools. Okay, someone that's not saving money at all, this is probably not right for you yet. There's something in your life where you don't get that you need to save money yet. So it's probably not the right move to be like, cool, I'm gonna, I'm not trying to convince someone that saving money is a good idea. Okay, if I have to do that, there's a lot more that this person doesn't understand. This is for someone that already knows they should save money. They already do save money, but they've just been giving it to the wrong places. They've been giving it to Wall Street and the banks and the IRS, and they would rather give it to their own bank instead. So that's who this is for. One final question before we wrap things up here. Is it better to open a policy on my child or on myself based on the health? Okay, so you can, if you're a parent, you can open a policy on your child. Okay, now here are the rules with this. So if you're opening a policy on your child, they need to do 10 times age per month. And they can also only have up to 50% of the death benefit that the parent has. Okay, these are the limitations. Now, 10 times age per month. If this equates to more than 50% of the death benefit of the parent, then I have to go with that number. This is whichever one's going to be smaller. Right? So, if I have 50% of the death benefit of my parent's got $2 million a month, right? My minimum is not going to be $1 million. My minimum will be 10 times the age, right? Then it's like, okay, I'm 10 years old. That's $100 a month, right? Now, if I'm trying to do $100 a month, and $100 a month means that I'm going to do, let's say $200,000 death benefit, but my parents only have 300 grand in force. You see what I mean? I'm not going to be able to do 200,000. I'm going to have to reduce that number down. And that's going to be, again, less than 10 times per month, which is fine. Okay, so I can open a policy on my child. It does not mean, though, that I'm going to be able to do the same funding I'd be able to do on myself. The insurance companies look at something called insurable interest. So they're going to say, good, like what makes sense to cover a child? Like what number makes sense for death benefit? And that's not going to be millions and millions of dollars. They're going to say, why in the world do you need to put millions of dollars of life insurance coverage on a child? Okay, there's a certain number within reason that they'll accept. So with a child, it's often going to be smaller. You're not going to be able to put in as much. And so we always recommend insuring yourself first if you can. Insure your spouse, insure, those that have incomes and things like that, because that's going to give you higher numbers. Then when you come and you try and put the policy on the child, you can do more because the mom, the dad, they both have high death benefits, and that actually bumps the cap up for the children too. Okay, so that's a great question there. All right, let me see if we have anything else in the chat. Jocelyn says she didn't know I had a podcast. Oh, Jocelyn, I apologize for that. That's my fault. If we're doing promotion and media and you guys don't know about it, it means we're not doing a good enough job yet. So that's totally my fault. So I want you to know that we have a podcast on Apple. It's on Spotify. It's on Audible. We also have a blog on Medium. If you go to jerryfetta.medium.com, we do a regular blog there. We do several podcast hostings with other podcasts. So if you go on any podcasting platform and you type in Jerry Fetta or Wealth Dynamics, you'll see that I do guest appearances on shows all over the country. And so those are all things that we want to make sure you're aware of. We have a question from Kevin. The death benefit would also change based on the health of the child, same as for anyone else, correct? Yep, that's totally correct. So if you're trying to insure your child and they have major medical history, it's gonna be harder to get them to be approved, right? Because it is life insurance, right? So that's another factor to consider. Good. I think we have time for one more question before we wrap up. So let me go ahead and pick one more. Okay, this is a good one. So we hear this one a lot. So why do I need to fund my policy for blah amount of years? Right. So it's kind of the question of like, when can I stop funding my policy? So let's say that I'm brand new at this and I'm like, I want to set up a policy, and we're like, good, you're scheduled to fund for 20 years. And immediately the person's like, I don't want to fund for 20 years. What if I can't? How do I stop early? You're again missing the point. Do you plan on never saving money at any point in your life? Like financially, is that ever going to be a good idea for you? I'm going to give you a hint. The answer is no. That's never going to be a good idea. Like if you come to me and you're like, hey, when I'm 70, I want to never save any more money. I'm going to be like, that's a terrible idea. You need to still save money. Otherwise, how do you keep growing? Right? The amount of 70-year-olds that are going to run out of money because they stopped doing the thing that got them to where they were in the first place. They broke the successful action. Okay, retirement doesn't mean insolvency. If you're not saving, you're on the road to insolvency. It's a matter of time. So you should always save. Savers aren't losers, by the way. Savers are future investors. Savers are the people that have the money. Okay, savers that don't do anything with their savings and leave it in the bank, yeah, those are losers. But that's not what we're telling you to do. We're saying save money. So someone that's saying, can I stop early? Here's what I want to ask you is 2 questions. Is it ever going to be a good idea for you to stop saving money? The answer to that is no. So then let's assume, okay, well, you're going to save money. Is it ever going to be a good idea for you to give the money to someone else's bank or to Wall Street or the IRS versus putting it in your own bank? If you're going to save, why not put it in your own bank? Why would you ever want to be like, back to Chick-fil-A as an example. Let's stop investing in Chick-fil-A. Let's go open up Burger King locations now instead. Like, why? That's completely non sequitur. Earn, save, invest. It's the triangle of wealth. Saving is what gets you to the point of being financially independent. So even once you are financially independent, you still should save 40% of your income so that you can continue investing, so that you can stay financially independent, so that you can build generational wealth for the next group in your family or for your church or for your charity or for whoever. So saving will always be a good idea, right? So to that note, no, you should not be thinking about how do I stop a policy early. And if I'm doing that, again, it just means I lack the financial education right now. There's so much consumerism out there with finances where it's like contributing your retirement plan until you're 59 and a half, right? Like why? And then you're just supposed to draw off of this magic nest egg that Wall Street's going to siphon fees off of, and they're going to do the volatility game and take money from you slowly until you die before it runs out. We're not playing that game here, right? So continue saving. And with a sacred account, you're going to do one of 2 things. You're going to do a 7 to 10 year funding period. That's if I'm trying to pay off my consumer debt or I'm trying to build fast reserves. That's the sacred account light. Or I'm going to do 20 years or more. That's going to be the sacred account premium, right? That's going to be longer term growth. And that's where I'm looking at, I want to do 20 years or to age 65 or for the rest of my life or for whatever it might be. Okay. So guys, that was our first round of FAQs. I think next week we'll cover some more. What I would love for you to do, if you're watching this and you have questions about the sacred account, I would love for you to email me, jerry@wealthdynamics.com. Okay, jerry@wealthdynamics.com, and tell me your questions. What would you like me to cover about the sacred account next week? Okay, so if you're watching the replay, same thing, email me, jerry@wealthdynamics.com. A few more things before we wrap up. Okay, I've got 3 or 4 things to cover really quickly. So first things first, if you did not set up your free appointment with Rodrigo and Brianna, do that now. Okay, do that now. Don't wait. Like this is something that time is not on your side. The longer you wait, the worse off it is. Start today, get that appointment set up with them. It's completely free and it's going to be a great experience and full of value. Second thing is if you did not get a copy of my book, okay, I am going to pester you about this one more time. Okay, go to jerryfetta.com/B2F promo and you can get a free copy of the book. We cover the book, you cover the shipping. We'll get that out to you immediately. You can start learning more about this. And if you enjoyed this today, imagine like learning about this throughout the week, how great that's going to be. So get the book. There's so much information that we just don't have time to cover on one Saturday. And this is going to give that to you. Okay, so that's the second thing. Third thing. Okay, so we do have a webinar coming up Wednesday night. Okay, Wednesday night, 6:30 p.m. Eastern time. Okay, I'm going to be doing an interview with Chris Noggle. Chris Noggle is also an expert in the sacred account and infinite banking concept. We've partnered up with him with Wealth Dynamics on our design, our back-end servicing. And so he's part of our team. His team is part of our team. And so we're going to be doing an interview with him to get his perspective on the sacred account. That's another great reason to email me your questions so that if you attend that webinar, Chris and I can answer some of those. So that's going to be 6:30 p.m. Eastern time this Wednesday. And then finally, keep an eye out Monday afternoon, 4 p.m. Eastern time. We will be releasing our next episode of Mini Moguls with me and Sammy to talk about money with kids, for parents, for anyone that wants to learn about it. And to be honest, most of us learn it like it's better if it's explained like it's being taught to an 11-year-old. That's one of the beauties behind doing that, is it's such a simple, if Sammy gets it, you guys for sure get it, right? So guys, that's all I got for today. Thank you for tuning in. Make sure that you tune in again next week. And I'm going to leave Brianna in charge of the chat here. So I'm going to exit, but I'll leave this open. If you guys want to connect for appointments, you want to network, you want to join our Facebook group or just get set up with an appointment, I'll leave Brianna in charge. Until next time, have a great Saturday.
All right. Do you guys that are still on have any questions that I could go ahead and answer before we wrap up today? As you can see, we've got a big support team for you that are all passionate to see you succeed financially. So don't hesitate. The squeaky wheel gets wheeled. Squeaky wheel. So Rod posted his chat link for if you guys want to book a time to chat with him above, and then my calendar link is posted as well. Okay. Well, if we are all done with questions, I'm going to go ahead and be ending this here soon. So I just want to say thank you so much again for everyone that booked the time to attend today. I know there's a lot of ways you could be spending your Saturdays, but focused on learning about finances is the best thing you can do for yourselves, I promise. So I appreciate seeing everyone taking that big step today. We'll see you guys on Wednesday at 6:30 p.m. for the webinar with Chris Noggle and Jerry Fetta, okay? Don't forget, be sure to check on Jerry's page, check your emails. If you're on our subscriber list, make sure you get registered for that webinar. Everyone have a great weekend. We'll see you next time.